Hi guys, my name is Tyler, financial advisor with Precision Insurance Services Inc. We have a partnership with Industrial Alliance. I wanted to make another video because I had a lot of requests with people that wanted to know more about mortgage insurance, how the investment component works within the mortgage insurance, and actually how you can use it when you buy your house, which is very important, especially when you're younger and you're working. You really want to plan it properly. So let's put an example here. Let's get right to the point. So let's say my client's name is John Client, and he's a male, and let's say he is 32 years old, and he doesn't smoke, okay? Let's say you buy a mortgage, or let's say you get a mortgage for about $500,000, for example, right? So you can actually get a mortgage insurance worth $500,000. Right, so this mortgage insurance only includes life insurance, and as you can see, it's a little bit pricey. It's about $623.56. I'm going to change the numbers, but I just wanted to give you an example. $498 would be for the cost of insurance, and $623.56 would be including the investment. So if you subtract this by this, you also have a savings component. You can use the savings components, buy a car, vacation, other major expenses, whatever you want to do with the money. As long as this is earning interest, you can actually use the funds, or you can basically just use it to save, and you can use it for whatever you want. Don't want to get too much to it. Let's just get right to that. So with this $623 per month, you can actually reduce it by adding a combination of a permanent life insurance and also a term insurance. That's what I usually recommend because of the cost. Depending, obviously if you're rich, that's a different story. But let's just put it for $100,000, for example, and you have a coverage rider, term rider of about 400,000, for example, 400K. Okay, so it'd be $169. Okay, that's pretty good. So $169 a month. So this, let's go over it. The 10-year term, this basically means that after 10 years, you would have to renew it at an older age because you're older. But if you'd like, you can actually convert this to permanent, which is like the guaranteed insurance within 10 years. So you can actually get the guaranteed plan, and there's no medical if you convert it within the 10 years. With the $100,000, this also has an investment component with it. So you can, as I said before, you can use the savings component with the interest that it earns to, you can withdraw it, and you can use it for any kind of expense, vehicle expense, travel expense, etc., etc., etc. So let's put in the illustration here, just so I can give you an example. I put 10% as a projection. Obviously, nothing is guaranteed. Yeah, 10%. So let's put the example here. So remember how I said the $100,000 is guaranteed? It's guaranteed because basically how the insurance companies program this is that they give you a guaranteed product where you pay for a specific amount of years, whether it be 20 years, 10 years, 15 years, or just pay for the rest of your life. You can actually get a plan where after you pay for 20 years, they guarantee that you can still get the death benefit. So knock on wood, you die. As long as you pay with your premiums within for all the months that it's accruing. So for example, 2,032.80, which is the yearly cost times 20, you're paying about 40,656. So as you can see in year 20, if you surrender the policy, this is the total surrender value, you actually get 42,142, right? So you get 42,142, you can surrender it, you get all your money back. Or what you can do is you can actually borrow against the 42,142, and then pay it back whenever you want. The insurance companies are very flexible, or you can schedule a monthly payment to pay it back, right? And as you can see here, after 20 years, after you stop paying, right, you still have to pay for your term insurance, which is the term, the other 400,000 component. Every 10 years you have to renew it. So as you can see, it's still included in the costs. And after 10 years, you're older again by another 20 years, because it's from here to here as 20 years, so it keeps going up. But if you'd like, within the 10 years, you can actually convert the term to permanent. Obviously, it'll be a little more expensive, but at least you can pay it off in 20 years, and you don't have to worry about the cost. Okay. Now, I wanted to give another example here. hope this is, hope you guys are following along. If you have any questions, just please just write a comment down and I'll be able to clarify. Let's remove this because it gets a little bit messy. Let's say, oh, Tyler, you know what? I don't like renting. I don't like anything that's not guaranteed. Okay, I can actually give you the actual 400,000 that was here, but we use investments to get the 400,000, if that makes sense. Okay, so let's say we only get $100,000. Obviously the mortgage insurance was, the mortgage was $500,000. So we're gonna get 100, but we're gonna get the extra 400 using investments to our advantage. Cool. So let's go back to the illustration. So there you go. Okay, so as you can see, you're paying about 1762 annually, 0.80 times 20. That's about 35,256. Okay, so you're paying that much in 20 years. As you can see, if you surrender the policy, you get 37,000. So minus 35,256, you're about 2,000 profit if you'd like, or you can keep the policy and just let the accumulation fund, which is the investments, just let it grow. So as you can see, after 20 years, it stops. You don't have to pay anymore, but the investment keeps on going up, which is called compound interest, which is interest earning on interest, and it just keeps, it keeps going and going and going. It's a domino effect. So after 20 years, you pay 35,256. The break-even point is at age 56 for a 32-year-old client after those years have gone by. So 35,256, and then the break-even is at 57. So at age 57, given that this interest rate is the true forecast, you would get all your money back at age 57, and on top of that, you would also have the death benefit, which is the life insurance, which forms part of the mortgage insurance, although it is optional, but it is very important that you have coverage because if something happens, knock on wood, where would you get the money? Your spouse or whoever you're living with would have to pay the bill, and it would be very costly, right? And you want to lose your house, right? So just to make it to break it down again, so after this age, at age 57, you can see that after that age, you're now in the money, which means you're making money now on top of your mortgage insurance. So as you can see, you can even use it as a source of actual income after you stop paying after 20 years, because the investment continues to grow, which is actually very good for estate planning because when we pass, I'm going on a tangent here, but when we do pass, the government taxes us on all our assets. So it's very important that we have insurance to cover those assets, because otherwise then we'd have to sell stuff or sell our properties to actually pay for the tax bill, which I'll be talking a little bit about more in my next video. Don't want to get too specific on this video, but this is specifically about mortgage insurance and using the investment as a savings plan. Let's use this. Speaking of the savings plan, let's say you're 65 and you're retired, and you have your CPP, you have your old age security, you have your RSP, you have your TFSA, you have your pension plan at work. You can also use the surrender value and the accumulation as a top up to your retirement. So let's say you're 65. Oh, Tyler, I have 112,135. What can I do with it? Well, you can borrow against the surrender value, borrow it, use this as collateral, use the investments as collateral just in case you default. They would have a backup plan. The insurance companies have a backup plan just in case. Say you pay back in 5 years, 1, 2, 3, 4, 5. You pay it back, and then you can actually withdraw from your investments. So you're kind of multiplying your retirement savings times 2, because you borrow, withdraw, as opposed to just withdrawing and then spending into nothing, right? So it's just kind of a strategy, if that makes sense. And that's really the whole point of life insurance, and obviously using it as part of your mortgage insurance, because if something does happen to you, you don't have money to pay off your mortgage, it's going to be quite difficult for you to actually get funds unless have a lot of savings. But you don't want to be wiping out your savings if your whole savings accounts if you've been saving for so long, right? That's why I always recommend that you start this early, because again, it is based on age and health. You don't want to be getting this stuff when you're older and things are already expensive, right? So for example, someone who's 32 would pay about 146, as opposed to somebody who's 42 would be paying 212. So you can see, I'm just getting really mathematical here. That's $66 a month. and you accrue that, or you keep paying that for the next 20, 30, 40, whatever payment plan you get, that's a lot of money that you could have been putting towards maybe your savings account, your TFSA, maybe your retirement plan. You could have been using that for groceries, maybe other investments, right? So you can see there's an opportunity cost, or there's an opportunity cost, or sacrificing one for the other by not, by not doing this. You're sacrificing losing this in the potential in the long term, because now everything is more higher, right? So this is very important to plan ahead, right? Because I want to give you another example here. Someone who's 20. Let's say they get a 20-year plan and they stop at 40, as opposed to somebody who's aged 40. Now they have to pay from age 40 to age 60. So who's more ahead in terms of this investment? Obviously the 20-year-old, right? So as you can see, it's pretty important to plan this earlier. Make sure you speak with the right advisor. Make sure your local advisor is letting you know all the different products out there, because it can be kind of messy if the plans aren't structured properly, or if it's if you have a plan that doesn't match with your needs. And, there's a lot of things to consider. But this is just a general overview. There's much more information to this, but I really wanted to give you guys an overview, because I had a lot of people that were asking me about this, and especially the young millennials nowadays. They want to get a house soon, so it's very important that you add this as part of your portfolio when you get a mortgage. So I'm going to be talking a little bit more about other types of mortgage insurances that that you can use. But for this one, I just wanted to talk about life, not so I don't get too technical. But I hope you guys learned a lot. I'll be linking my phone number, my direct office line, my direct line, as well as my email. You can also message me on LinkedIn and Messenger. If you have any questions, please contact me in the following information. And I look forward to seeing the next video, and I hope you guys are learning a lot. Thank you so much, and I'll see you in the next video.